Okay, welcome into another week's market update. It's the 5th of April. Now, don't forget that any advice contained within this presentation is general only, so it is tailored to your particular circumstances. You need to decide for yourself what is appropriate to you. Okay, so once again, we started off a very strong day today, ended up just slightly in the green there. We can see that for about a whole week now, we're consolidated, and we're consolidating roughly between 75.50, which is an old resistance from back in time, okay, back all the way back here in 2021. And basically, we're holding at this point around that sort of 74.80 as support. There's an overall short-term uptrend that's been created through here, a few higher peaks and higher troughs, massive relief rally from the bottom of where we sort of fell after the Ukraine situation broke out. Looking at about 8.5% from the lows at this point in one big swoop, guys, okay, which is unusual, all right? Unusual for this to keep going, really, without some form of sideways period or a pullback. Historically, we've seen these types of moves before where the market just shoots up, but it tends to then grind for a while. Shoots up, pulls back a little bit, perhaps, right? Through here, we saw a big movement sideways, okay? Big movement sideways, bit of a relax, and then go again. Trends don't just go straight up, guys, right? It's very, very, very rare to see a market just shoot straight higher month after month after month. So I suspect we're going to hit a top of this soon, right? When I say top, I don't think we're going to pull back a whole heap. I don't think we're going to turn back into a bear trend or anything like that. But I do believe a breather and perhaps a small pullback down near this 200-day moving average is on the table. So let's just see, this is typical to see at the top of a move, right? Which is that real grind sideways, then a pullback. It's very typical to see. You can see these types of movements happen all the time. And they tend, more times than not, to lead to a small pullback before that trend continues. Every short-term indicator I've got is saying this market's overbought. But these indicators, they can stay in the overbought area for quite some time when the market's in a very strong move. So, it doesn't call the top, guys, these indicators, but it does say that we're overdue for a pullback at some point. S&P 500, so there's top 500 stocks in the US. Well, they're actually looking a little bit bullish again, right? So they had a big reversal on Friday, another fresh bullish signal off the 200-day moving average. If that continues through and breaks through these resistance levels, guys, they're looking quite bullish, right? They're nowhere near their all-time highs yet. We're right at our all-time highs. So from that respect, we're a little bit in front at the moment in the short term. Nowhere near in front in the long term, obviously, but in the very, very short term here, this relief rally, the Australian market has gone a little bit further. And there's reasons for that. One of the big reasons is that we're a exporting country. We're a mining country. We've got metals and energy prices elevated. We've got agricultural prices elevated at the moment. And all of that helps our exports. That means more tax dollars, and that just means more money coming into this country. At the same time, the Aussie dollar has gone up, but it hasn't gone up as much as I would expect considering the situation we're in at the moment. So 75 against the USD, I still think that's fairly low considering iron ore's back at 160 again, and what we've been seeing in the metals market and the agricultural markets. So go figure, right? It's interesting, but definitely the environment out there is a bit more favorable for us here in Australia, value-based stocks mainly, and definitely a lot of exporters here as well. Alrighty, so at this point of time, guys, look, the rally last night in the US was also more done by the growth space, so it was tech, discretionary, communication service stocks. That rally, I think, was sparked more so because of announcements from Elon Musk and the fact that he now owns about almost 10% of Twitter. I think that just spurred a bit of buying in that space. That might last a few days. Look, at this stage, the futures are sitting a little bit in the red. They have been all day. In fact, they'll probably be a bit heavier in the red earlier in the day for the US futures, and now Dow futures are only 40 points down. It's not a lot, right? But I'm struggling to see this rally continue. I really am, guys. If things are looking a bit overdone, There might be a couple more days in this, and then I think we're way overdue for a bit of sideways. Because even the US market has these periods of sideways, and I think we're overdue one of these sort of sideways movements for at least 4 weeks. US reporting kicks off next week, right? So how that goes will really might dictate what happens next as well. But I suspect we might have a little bit of a breather now coming into that reporting, and then how that reporting goes will really determine the market move. I suspect some companies are going to be doing it tough amongst the supply chain issues and inflation we've seen so far, and others will be doing really, really well. Okay, just as we're seeing that in our market. Miners are killing it, energy stocks are killing it, but you got the likes of other sort of discretionary stocks that might be starting to feel the pinch soon. Okay, all right. So the big thing to watch right now, guys, is energy prices and really like prices across the board in commodities. You've got crude that continues to toy with us. Your crude that continues to toy with us, it's run up all the way to 120 at the highs, and it keeps hanging around $100 US a barrel at the moment. So at this point, guys, we could see things continue higher. We may not. It's just so much. It's so muddy at the moment around that space. Can we see supply from other countries come on? We know some countries are still buying Russian oil and Russian gas, so we might not be as under the supplied as we might think. We do feel in the long run, though, guys, I think there will become a time where there will be a continued supply problem in oil, right? There's all the chances that in the next 6 to 12 months, oil prices could continue to shoot higher. And that's going to really depend on whether we can see some fresh supply onto markets. You got to remember the world's still coming out of lockdowns, all right? The world's still coming out of COVID issues. One of the reasons why oil prices pulled back was news out of China that they're going back into lockdowns. So that will all change, right? So the dynamic there, the supply and demand dynamic in oil right now is very hard to predict. And I think that's going to create a lot of uncertainty around inflation moving forward. So that's one thing we've got to watch. The other things, obviously, with what's happening in Ukraine and Russia, we've also seen agricultural prices go up. So wheat, oats, corn, those types of products that are in a lot of the major manufactured food products. You're going to find most packaged goods are going to go up in price dramatically compared to fresh produce, I feel. We're already seeing signs of that here locally, and I think that's going to be the theme, especially in Australia. Overseas, obviously the inflation issue is a lot worse than what it is here so far, and we'll be watching to see how that plays out in the coming months. But we heard from the RBA today. RBA held rates low again with no hint on what they're going to do next. They're still monitoring inflation, and they're still saying they want to see inflation be maintained between their 2 to 3% target. We haven't gone above their 3% target, guys. We're within the target. You got to remember pre-COVID and really the last 2 to 3 years. Or pre-COVID, we saw inflation almost in deflationary areas, right? We had really low inflation for many, many years leading up into COVID, and then the supply chain issues caused an inflation bump. And that's continued now. We've got huge supply chain issues that it's going to take time to clear up, especially now we've got a whole Ukraine-Russia war situation playing out as well. So look, RBA is sitting on their hands. I think they're a little bit more hamstrung compared to the Fed. The Fed is a lot more willing to raise rates. There's a different dynamic over in the US in rates than what there is here locally. Over in the US, many homeowners have their loans fixed in for maybe 15 to 30 years. Okay. So many people would have already fixed at lower rates, and they're sitting pretty until rates come back down again and they can remortgage. They can weather all of these rate hikes. Okay. What it's going to do is stop new people from getting into markets. It's also going to slow down companies from spending. So it hits companies more than it does hit the overall consumer over in America. Locally, it's a little bit different because most people are either on a 1, 2, 3, or 4 fixed year fixed loan. And if they haven't fixed, they're on variable. And if the RBA increases rates, that's a direct effect straight away on people's expenditure, right? So their loan repayments each month go up, therefore they got less to spend out in the economy. So it's a little bit different here, and I think the RBA will hold on or hold off raising rates for as long as they possibly can, until they can get to a point where the economy is strong enough to withstand it. I feel if they, with inflation going up, with food prices going up, with the general goods, everything going up in price, an increase of rates from the RBA at the wrong time could be actually quite devastating for the economy here. Yes, we'll have mining. Yes, our companies will do well. Exporters will do well, but the everyday consumer is going to get affected pretty badly if they both have inflation from food prices and things like that, rent, all of that going up, as well as the RBA increasing interest rates at the exact same time. RBA increases rates, everything goes up. Rent will go up, everything will go up as well. So a lift in interest rates from the RBA is very inflationary as well, in certain ways. Okay, so it's an interesting dynamic. I think a lot more thought has to be put into it by everybody before the RBA does anything. So it is all about inflation and interest rates. That's the conversation right now. What are we seeing out there, guys? We're seeing a inversion of the yield curve in the US. That is a major warning sign of a recession coming. So what are the two things the bond market's telling us? One, it's telling us interest rates are going up in the US, right? That's the number one thing. Even here locally, our bond markets are elevated, suggesting rates should go up. So that's one thing, right? They believe rates have to go up to battle inflation. That's the story, okay? Then the other part of it is if interest rates do go up and this inflation persists, people believe a recession is coming. They believe the growth in the economy that we're seeing right now will be short lived, it will only live for a year or two. Then things are going to flatten out and go into recession in the US. So that's an interesting thing there, guys, to unpack. It means we're probably bullish the economy short term, but if the Fed does what they're looking to do, or if inflation doesn't come back into control, we're heading towards straight into a recession. So what we have to look out for here, guys, I'm going to bring it back to this, and I said this earlier, it's all about energy and agricultural futures. I'll be watching that like a hawk. If things continue to escalate and get out of control, if we see oil up at 140, 180 like people were predicting, if we see food prices continue to rocket out of control, it will send the world into a recession if nothing's done about it. So that's, I think, the major risk. Okay, we've got the bond market telling us that there's a major risk to everything at the moment, a major recession risk. Okay, which means we could see another market crash. But that will only play out if the Fed goes too quick on interest rates, as well as the inflation getting out of hand side by side. Because let's face it, guys, if the war in Ukraine continues and things continue to worsen there, and we get a reopening of the world economy, if we cannot get the supply of crude oil up, inflation will get out of control. That's I think going to be the number one cause of inflation will be crude oil, because that flows through to almost everything, and we're not really at a point where we can switch to all electric just yet. So I think really what happens to the world economy next is really in the hands of what happens to crude oil. So watch that space, guys. That is your short-term indicator of a crash in the market. If crude breaks recent highs of 120, I think the market could easily pull back quite a bit on inflation fears. So to me, that's the big one to watch. Okay, that's going to put pressure on the Fed to increase rates, which I think is a stupid thing to do when you've got inflationary pressure, prices are going up, plus you get increased interest rates at the same time, which makes it harder for people to get home loans. We are going to go for a recession if that all plays out, right? But on the flip side, if oil calms down, if we see oil prices come back down to 80 and the Fed increases rates a little bit, you continue to see strong economic data, everything will be fine. So, yeah, I'd be watching the direction of oil. All right, that's my number one indicator right now. I spoke about the yield curve. It's inverted in the US at the moment. The 2 year right through to the tens now inverting, and that's a strong sign of recession's coming. So yeah, watch that space. If it continues to invert, if that gets worse, um, yeah, well, yeah, it's not going to be pretty. So that's where we're at, guys. Look, there's some serious warning signs out there. Don't ignore them. They are longer term. Just keep an open mind because things can change very quickly. And a big if things can calm down in the whole Russia-Ukraine situation, if we start to see agricultural prices come back off again, if we start to see oil prices and energy prices come back off again, then the mood will change. I think that yield curve will correct itself. I don't think the Fed will lift rates as much as what they're indicating they will right now, and things will cool back to where we were late last year. Okay, where we'll focus on the economic recovery coming out of COVID. I do believe metals prices and industrial commodities prices will remain elevated for a period of time. So iron ore, I think, is going to stay high. I think copper, aluminium, zinc, nickel, rare earths, all of that's going to be in high demand in the coming years as we all try to move towards green energy. So but I think there's room for oil to come back down if conflict resolves. Feel there's room for food prices to come back down if things resolve. That's what we've got to look out for, guys, for the mood of the market in the coming 6 to 12 months. Okay. Short term, overbought. I feel our market needs to have a breather here for a bit before it continues higher. That's where we're at right now. Okay, so thanks for listening. It's a bit of a longer video at the moment. There's a fair bit going on, so a bit to cover. So I hope you enjoyed that video, and I'll catch you all next week. Bye for now.